What's up, everybody? Today we're going to be taking a look at two companies that I own. Both of these stocks are in my portfolio and they both reported earnings very recently. We're going to check out their results. We're going to look at the risk reward, see if there's still value here. And as always, this is not a recommendation to buy any of these stocks. I just give you my opinion and I tell you what I'm doing with my money. If you get value out of the video, subscribe to my channel. If you want my Google Sheets template where you can make sheets like this, consider following me on Patreon. I'll put the link to that down below. Now let's get started, and we're going to get into Nomad Foods, ticker symbol NOMD. This is a stock I've talked about now several times on the channel. Obviously, it hasn't been a fun 5 years for shareholders. The stock is down roughly 50% over that time. Meanwhile, over the past 5 years, revenue has just slowly climbed up, margins have remained consistent, and the company has been returning a lot of capital to shareholders in the form of not just buybacks, but a very nice dividend. They pay right now about a 5.5% dividend. I made my first purchase of this stock around $13 and change. I said I thought Nomad was simply too cheap. As it has dropped down, I've bought more. My average cost is now $12 and change, a little bit higher than where the stock is trading right now. They just released earnings a couple days ago, and on this report, the stock was up, maybe 6-7-ish%. It was just above $11 a share, and now we're back to a little over 12. So let's take a look at this report. It hasn't been a great year for Nomad. There are reasons why the stock is under pressure. I just simply felt like it has sold off way too much. If you aren't familiar with this company, very boring business. They sell frozen food. They are the market leader in frozen food in Europe. So that's frozen protein like fish and chicken, also frozen vegetables like peas. They have a relatively small ice cream business. So yeah, pretty boring company, and they've been a slow grower. Except this year, they're now reporting contracting growth. Top line down about 2%. They had a rough, hot summer that has led to higher costs, lower yields on their farming. Also, because they're selling into retailers, to grocery stores, there's periodic inventory effects where the sell-in might be a little bit lumpier than the sell-through to consumers. In any case, top-line growth pretty meh, but they say, trends sequentially improved through the quarter. Net sales returned to low single-digit growth by quarter end. And honestly, low single-digit growth on the top line is about what I expect for this company. This is certainly not a growth story. I roughly expect them to grow their top line in line with inflation. And speaking of inflation, they certainly have experienced a lot of inflation on their costs. That has brought down their margins and it's put earnings under pressure. They've announced that they are going to increase prices in 2026. However, they've not significantly increased prices this year. So they've basically just eaten this inflation. They have not passed this on to the consumer. So the result, adjusted EPS down 11%. Full year results going to be near the low end of their ranges on both top line and bottom line. So why are we invested? Why do we like this company? Well, just in the first 3 quarters, we see the company has returned cash to shareholders in the form of buybacks and dividends in the amount of, about 220 euros here. We'll call it $250 million roughly. They still are very profitable and they're returning a ton of that cash to shareholders. This is a company that is trading for about 1.8 billion US dollars. Their free cash flow, roughly about, we'll call it like 360-ish million US dollars. So they have a 20% free cash flow yield. This company is trading like 5 to 6 times free cash flow, and they return a ton of that cash to shareholders. You really don't need any growth here to have incredible returns. According to this source, trading at roughly 6 times forward earnings, 6 times forward cash flow. If we just take a look at Nomad on my website here, trading at roughly 6 times forward earnings. And yeah, you see here, 20% free cash flow yield. Their volume in the UK has been weak. Honestly, this has been where the majority of their underperformance has been coming from. But we see at the very end of Q3 ticking back up, about up to break even. So hopefully if this trend continues, they're back to low single digit growth. And yeah, 2025, not going to be an amazing year. Overall revenue pretty much down 1%, let's call it. Bottom line down a little bit more. Again, they haven't passed on the inflation that they're experiencing on costs to consumers yet. They're saying they're going to increase prices in 2026. We'll see what that does to demand and volume, but something they're going to have to do at some point here. And as far as the bottom line earnings per share, you're looking at a little under $2 in earnings per share for this company. And again, this is a stock that is trading for $12. On the earnings call, talking about the things that put them under pressure this year, like bad weather and also inventory effects, they say, this has been a large headwind for us this year, but the good news is these are cyclical headwinds and not structural. And we're already already seeing improvement as we cycle them. They have some new chicken products that they say are performing well, but again, wouldn't count on much growth for this company. This is really a classic value story, and here's one part of the call I just want to point out. Martin Franklin is one of the founders of this company, and he says, first, Noam and I, so those are the two co-founders, own collectively 16% of the outstanding shares. We hold the vast majority of our original shareholdings. We have lived through ups and downs and have every intention of working to drive the company to recapture the value from past highs and beyond. I personally have chaired a company through such a cycle, and today it is stronger than ever, trading at or around all-time highs. He's talking about another company he owns there. Secondly, because of this dislocation, and here dislocation, he's talking about what he sees as a disconnect between the value of the underlying business and the current price. Because of this dislocation, we have been prioritizing share repurchases as a primary use of Nomad's cash flow after dividends are paid. This will remain our priority for capital allocation as long as our stock remains so undervalued. It is our core mission to have equity markets appreciate the strength of this company, and we expect to earn that appreciation by delivering better results starting next quarter. So Martin is not the CEO, but he is still involved in this business, and the founders, the insiders, are very aligned with us shareholders. They're doing what they think is best for shareholder value, and he concludes saying, in closing, we built a tremendous foundation, and I truly believe now is a great time to be an investor in Nomad Foods. There's enormous upside from here, and Noam and I plan to work with Dominic, the new CEO, to ensure that that opportunity is realized. So obviously, he's going to be biased, but looking at the numbers, I agree. Nomad is undervalued. One of the concerns I had with this company is their debt. They do have a significant amount of debt, about $2 billion US. A lot of this debt is in euros. That's about 5 times operating income, so definitely on the high side. They did recently roll over a bunch of their debt, so they issued a couple new loans that are due in 2032. It's going to be used to pay off the debt that was previously due in 2028 and 2029. And there's a little bit extra money that they are taking out in these loans. I wouldn't be surprised if they returned that to shareholders in the form of buybacks. In any case, there are no significant near-term maturities. So while yes, the debt is high, the balance sheet is okay in the medium term. Now, looking at what we can expect for a return on our investment, if we invest in Nomad stock today, I really haven't changed much here. I'm assuming no revenue growth in my base case. I think they're likely to outperform this. I think over 5 years, low single digits is more to be expected, but I'm going to leave it at 0. Operating margins have been incredibly consistent. I'm just going to leave that at 12%. They return a ton of cash flow to shareholders, so that's what this number is representing here, and I'm only giving them a 9 times multiple. I think that's fair for a company like this, and in this scenario, you're looking at an 18% annualized return. That's well more than a double over 5 years, and honestly, I think they could outperform a lot of the numbers that we put in here. As far as our bear case, I'm assuming that revenue continues to slide 2% every year for 5 years. Operating margins also slide down to 11%. This would be basically the lowest margins the company has ever had. I also pulled back their free cash flow that they're returning to shareholders, and I'm only giving them an 8 times multiple. Maybe that's even high in the case of a declining business in this scenario. So let's put in 7 times, and we see that you're down 3% roughly every year for 5 years. Obviously not great, but in my opinion, this is acceptable risk for such a pessimistic scenario. Now, in the bull case, I'm assuming 4% growth on the top line, margins stay basically where they are, and I'm giving them a 12 times multiple. This really isn't anything too crazy, and in this scenario, you're looking at a 35% annualized return. This is more than a 4x on your money over 5 years. So overall, what do I think of Nomad at these prices? I think the risk reward is very good. I agree with the co-founder Martin. I think Nomad is an excellent investment at these prices. That's just my opinion. I would like to grow my position in Nomad. I've gradually been, nibbling more and more shares over the past month. I think this is somewhere around a 3% holding in my portfolio. So I might be looking to expand my position here, assuming the price doesn't run too far away from me. Totally fine if prices stay low, similar to how they are now, for a few more months while I can build my position. Now let's move on to the second company. And the next stock we're going to talk about is StoneCo, ticker symbol STNE. This is a relatively large holding for me. It's been roughly a double from the point where I was buying, but they just released earnings. The stock was down about 10% on this report. So let's take a look at it, decide, do we think StoneCo is still value? How is the business doing? What do we want to do with our position here? I have talked about StoneCo before, but if you're not familiar with the business, they are a payments processor in Brazil. They're primarily targeting small and medium businesses. They have these little payment point of sale terminals. In the past few years, they've been moving away from relying on just their take rate on payments and moving into banking and credit. They make loans to merchants. They earn a spread on those loans. And really that banking and credit piece is where it seems like a lot of the growth is. They're on track to hit their guidance for 2025. Gross profit up 15% year over year. Bottom line earnings per share up over 30% year over year. That's huge. We'll get to why that is so high in a moment. But, this number here, adjusted basic EPS, they're actually including discontinued operations in this. They sold off part of their software division early in the year. If I just look at what this guide is implying for just earnings per share, we're looking at about 9 reais a share for 2025, or in US dollars, that's, about $1.80, maybe just a hair less. The stock right now is trading for a little under $17 a share. So, this company is trading for less than 10 times earnings. Even after the huge run up in price this year, the stock really is not expensive. Now let's talk about why earnings per share is up, over 30% year over year. And yet at the same time, net income only up about 13% if we're just looking at continuing operations. Well, the reason is the number of shares has gone down dramatically. This company has been buying back stock very aggressively. Just since the beginning of the year, they bought back roughly 10% of shares year over year. That number is even higher. On their website, they say every month how many shares they bought back. At the beginning of the year, there were, roughly 300 million shares outstanding. So just in January, buying back a little over 1.5% of the company, then buying back 1.5% of the company in February, March, buying back close to 2% of the company. Really quickly, these numbers add up, and management was clearly very aggressive about buying back shares when they were cheap in the beginning of the year. They bought back almost 10 million shares, about 3% of the company, just in 1 month in December of last year. As the stock price has gone up, share repurchases have gone down. But, something interesting to me, just recently in October, the past month, they bought back 5 million shares. So close to 2% of all outstanding shares in only a month at an average price of $18 a share. Seems aggressive, but management feels that this is the best way to return value to shareholders. Moving through and looking at their segments, let's start with payments. This has been the core of the business. Previously, this has been growing a lot faster, so while growth is certainly not bad here, total payment volume, which is a pretty important number to look at in terms of payments, it's been growing 11% year over year, but if you break that down, it's only been growing about 6% in terms of cards. Most of the growth here has been in Pix transactions, which Pix, it's an instant payment system. You can think of it maybe a little bit like Venmo, but it's managed by the Central Bank of Brazil. It's a real-time transaction. It is essentially free for individuals. Merchants will pay a small fee here to StoneCo for managing these transactions, but the take rate here is very low. So in other words, a lot of the growth is in this low take rate area. The growth in the higher take rate segment, only 6% year over year. And they say total payment volume growth, maybe slowing to high single digits. And these numbers, of course, are all in local currency. The Brazilian real has appreciated relative to the dollar. So over the past year, the dollar is, roughly down 16% against the Brazilian real. This has been a huge tailwind for investors in StoneCo. The results in dollar terms look even better. But, do we expect that to continue over the next year, over the next 5 years? Personally, no, I don't. And in fact, there is currency risk here. I think it's much more likely than not that the Brazilian real depreciates against the dollar in the future. So when we're putting assumptions into our sheet, we need to take that into account. We need to give a little bit of a buffer for currency risk. Now, moving on to banking and credit, these are more newer segments for StoneCo. They have done a very good job selling their financial services to their merchant partners. Clients up 20%, deposits up over 30%. This growth I expect to slow down. And as far as credit, this is an even newer segment. These are loans that they are lending out primarily to merchants. We see just a year ago, their credit portfolio wasn't even $1 billion real. Now it is up to over $2 billion. So a ton of growth here. One thing you want to keep an eye on with any credit portfolio is non-performing loans. What do defaults look like? What is their risk here? Obviously, it's been increasing over the past year. You can't really have a non-performing loan right when you issue a loan. So the fact that their credit portfolio was very new a year or two ago, non-performing loans was close to zero, and now it's going up. They say they expect this number to reach high single digits investments. So as the portfolio matures, this number will go up, and StoneCo is taking provisions for these losses up front. We see on their financial statements allowance for expected credit losses. So as this portfolio increases, that does increase risk, but management thinks they're being prudent here with how they're accounting for that. Now, overall, looking at the business, looking at their guidance, it seems to be a company that is on track. It's a solid quarter. They executed pretty well. There definitely are some concerns on payments, that growth is slowing. Total payment volume definitely slowing down a little bit. Management talked about the macroeconomic environment in Brazil multiple times and said, yes, it's under pressure. Things are not as good as we thought that they might be. Also, higher interest rates in the company, that's definitely a headwind. Finally, management has always been a little more long-term focused. They've highlighted in the past their 2027 guidance. They're looking for earnings per share of roughly 15 reais a share. At current exchange rates, that's about $3 US a share. Part of their assumptions here are 14% CAGR on total payment volume growth. Right now, they're a little bit below this. On the earnings call, they said, we want to see how the year closes out before we give more concrete guidance about 2027 numbers. So thus far, they have been on track to hit this. However, it seems like things may be slowing down. Some rough back of the envelope math, roughly right now, they're at $1.80-ish in earnings per share. So trading between a 9 and 10 times multiple. If they hit, $3-ish in earnings per share in a few years, give them a 10-ish times multiple, and you're looking at a $30 stock. If they slow down, maybe they fall short. Also, I should just point out for anyone who's looking at their financials and sees, hey, net income is negative. What's going on there? Well, they took a massive write-down in goodwill, and this is related to Links. This is part of their software segment. They ended up selling off this portion of the business. They've used a lot of the cash related to that transaction to simply buy back stock. If you were just looking at continuing operations, not looking at the change in goodwill from Links, this would be more like, $450 million here. So pretty significant difference. And again, for a company that is trading for, roughly 4.5 billion US, about, 10-ish times earnings. This site is saying 8-ish times next 12-month earnings. So not really that expensive and definitely still growing. I will say it's difficult to put numbers into our sheet and come up with an estimate for future value for a company like this for a couple reasons. First of all, the way that they account for operating income. They're not doing anything shady here, but as a financial company, interest expense, that is really part of your operations. Part of the core business is, making a spread on interest. Also, it's difficult to just simply look at free cash flow for a financial company. In many cases, free cash flow as a metric doesn't really make sense for a financial services company where their core business is moving cash around. As you make money, as you make real earnings, often that cash will simply go out in the form of loans, especially if you are actively increasing your credit portfolio. So free cash flow can be zero or even negative in spite of the fact that the core business is improving and is very profitable. Usually for a financial services company, it's better just to look at net income. But again, here with StoneCo, they also have impairments to goodwill related to Links. So, it's a bit of a difficult company to look at. And I think that's part of the reason why a lot of people were sleeping on it. When I bought this company, it wasn't even really one of those businesses that you have to look at in a spreadsheet and decide, what's my bull case and bear case. When I bought this company, this was a business that was trading for, roughly 6 to 7-ish times earnings, that was growing double digits and was very shareholder friendly, being extremely aggressive about buybacks. It honestly felt like a no-brainer. Now today at, more like 10-ish times earnings and with growth slowing, the risk reward simply isn't as good as it was earlier in the year. I should mention this stock used to trade, around $80 a share back in 2021. At this time, Berkshire Hathaway, Warren Buffett's company, was an investor in StoneCo. It had a massive drop, and looking at the chart here, it looks like it's been relatively stagnant for the past 3 years. These ups and downs are a bit more than they might appear on this graph here. But as far as what I'm doing with StoneCo stock after this earnings report, and again, shares were down, roughly 10% on these earnings, I'm just planning to hold my StoneCo shares here. StoneCo still looks like reasonable value. Yes, there's risk. It's in Brazil. It's not as dirt cheap as it was. Growth is slowing, but I'm still looking at a shareholder-friendly business trading for less than 10 times earnings, growing at, probably still at least 10% in US dollar terms. I'm just going to hold my shares. Again, none of this is advice to do anything with StoneCo stock or Nomad. I'm just giving you my opinion. So if you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said, leave that down in a comment below. If you want to support what I do or get my template for Google Sheets, follow me on Patreon, and I hope to see you all in another video.